Picture this. You have been doing everything right. You have been saving carefully, investing wisely, and growing your tax-free savings account for years, maybe even decades. You followed the rules. You stayed within your contribution limits. You never touched money you were not supposed to. And then one day, completely out of nowhere, you receive a letter from the Canada Revenue Agency telling you that you owe tax on your TFSA. Not a small amount. Not a clerical error they will quickly fix. A real, legitimate tax bill on an account that was supposed to be completely tax-free. How is that possible? How does a tax-free account generate a tax bill? And more importantly, could it happen to you right now, in 2026, without you even realizing it? The answer to that last question is yes. And that is exactly what we are going to talk about today. Stay right here, because in the next few minutes, I am going to walk you through the new developments around TFSA rules in May 2026, the specific mistakes that are triggering CRA audits, and unexpected tax bills for ordinary Canadians, and, most critically, exactly what you need to check in your own account right now to make sure you are fully protected. If you have a TFSA, this video is not optional. This is essential. Welcome back, and if you are new here, perfect timing. This is Pension Facts Canada, the channel where we cut through the government language, the financial jargon, and the confusing fine print to bring you clear, accurate, and genuinely useful information about the money systems that affect your life every single day. We cover TFSAs, RRSPs, CPP, OAS, GIS, CRA updates, tax changes, and everything in between. Always with accuracy, always with honesty, and always with you in mind. Today we are zeroing in on the TFSA, and I want to be very clear about something before we go any further. The information in this video is real. The risks I am going to describe are real. The tax bills being sent to Canadian TFSA holders are real. This is not fear-mongering. This is a wake-up call that too many Canadians need and are not getting anywhere else. So let us get into it. The tax-free savings account was introduced in Canada in 2009, and it quickly became one of the most popular and most powerful savings tools ever offered to Canadians. The concept is beautifully simple. You contribute money you have already paid tax on. You invest it inside the account. It grows completely tax-free, and you can withdraw it at any time without paying a single dollar in tax on the gains. No tax on interest, no tax on dividends, no tax on capital gains, nothing. It is genuinely one of the best financial tools a Canadian can use. And over 16 years since its introduction, millions of Canadians have taken full advantage of it. But here's the thing about powerful tools. When you use them incorrectly, they can cause serious damage. And in 2026, the CRA is paying closer attention to how Canadians are using their TFSAs than at almost any point since the account was first introduced. The question is, are you using yours correctly? Let me take you back to something that happened quietly in the background over the past few years, because this is the context that makes everything happening in May 2026 make complete sense. The CRA has been systematically expanding its ability to monitor investment accounts, cross-reference financial data, and flag unusual activity inside registered accounts, including TFSAs. They have invested in new technology. They have hired more auditors, and they have made it very clear through a series of tax court cases and public statements that they intend to challenge TFSA arrangements that they believe violate the spirit or the letter of the rules, even when the account holders themselves had no idea they were doing anything wrong. That last part is what I want you to really hold on to, because it is the thread that runs through everything we are going to talk about today. You can violate TFSA rules without knowing it, and in 2026, the consequences of doing so are more significant than ever. So let us talk about the specific rules and the specific situations that are getting Canadian TFSA holders into trouble right now. The first and most well-known issue is overcontribution. Every year, the Canadian government sets a new TFSA contribution limit. For 2026, the annual contribution room is $7,000, continuing the amount that has been in place for recent years and adjusted periodically for inflation. But here's where so many people go wrong. The annual limit is not the only number that matters. Your total available contribution room is cumulative. It builds up every year you have been eligible but not contributed, It is reduced by contributions you have made, and it is restored, but not immediately when you make withdrawals. If you withdrew money from your TFSA in 2025, that room does not come back until January 1st of 2026. If you recontributed that money in 2025 before the year ended, thinking your room had refreshed, you overcontributed. And overcontributions are taxed at 1% per month on the excess amount for every month the excess sits in your account. 1% sounds small, but on a $10,000 overcontribution, that is $100 per month, $1,200 per year, for a completely avoidable mistake. The CRA does not always catch this immediately, which means some Canadians have been quietly accumulating this tax liability for months or even years without realizing it. The second issue is one that has been generating a growing number of CRA audit cases, and it involves something called trading activity that the CRA considers to constitute carrying on a business inside a TFSA. Here is the open loop I want you to sit with for a moment. The CRA has the legal authority to determine that the investment activity inside your TFSA is not passive investing, but is instead active business income. And if they make that determination, your TFSA loses its tax-free status on those gains entirely. I know that sounds almost unbelievable, so let me explain exactly what this means and why it is affecting more Canadians in 2026 than ever before. The TFSA was designed for passive investing, buying stocks, ETFs, mutual funds, bonds, GICs, and holding them over time. It was not designed to be a platform for active day trading. If you are buying and selling stocks rapidly, turning over your entire portfolio multiple times a year, and generating significant gains through high-frequency trading activity inside your TFSA, the CRA can argue, and has successfully argued in tax court, that you are carrying on a business, and that business income is taxable even inside a registered account. The fact that it is inside a TFSA does not protect you if the activity inside it looks more like a business operation than a personal savings plan. There have been multiple tax court cases in Canada where individuals lost this argument and received tax bills in the tens of thousands of dollars on gains they believed were completely sheltered. And with the rise of commission-free trading apps that make it easier than ever for everyday Canadians to trade frequently, this issue is becoming more prevalent, and the CRA is watching more carefully. Now here is the pattern interrupt, because I want you to stop for a second and ask yourself an honest question. Are you someone who trades actively inside your TFSA? Are you someone who buys and sells stocks regularly, chases momentum plays, or turns over a significant portion of your portfolio multiple times a year? If the answer is yes, this section of today's video was written specifically for you. I am not saying you are definitely in trouble. I am saying you need to be aware that this is a real risk. The CRA is actively pursuing these cases in 2026, and a conversation with a qualified tax advisor is not optional for you. It is urgent. The third issue causing unexpected tax problems for TFSA holders in 2026 involves foreign investments and foreign withholding taxes. And this one catches a lot of sophisticated, well-informed investors completely off guard. Many Canadians hold United States dividend-paying stocks or U.S.-listed ETFs inside their TFSA. They do this because the TFSA offers tax-free growth, so they assume they are sheltering those dividends from Canadian tax. And they are right. Those dividends are not subject to Canadian income tax inside the TFSA. But here is what most people do not know. The United States government does not recognize the Canadian TFSA as a tax-exempt account the way it recognizes the RRSP. As a result, the United States applies a 15% withholding tax on dividends paid from U.S. securities held in a TFSA. And that 15% is withheld automatically at source before the money ever lands in your account. You cannot claim it back. You cannot recover it through a foreign tax credit inside a TFSA the way you might be able to in a non-registered account. It is simply gone. This is not a new rule, but it is one that is generating fresh confusion and frustration. In 2026, as more Canadians move into U.S.-listed investments through their TFSAs without understanding the cross-border tax implications. If you hold U.S. dividend stocks or ETFs inside your TFSA, you are almost certainly experiencing this withholding tax right now. and you may not have even noticed it on your statements. The fourth issue is around prohibited and non-qualified investments inside a TFSA. The rules around what you are allowed to hold in a registered account are specific, and violating them can trigger significant penalties. Shares of a company in which you own a significant interest, certain debt obligations, and various other investment types are considered either prohibited or non-qualified inside a TFSA. Holding them results in a tax of 50% of the fair market value of the investment at the time it was acquired or became non-qualified. 50%? This is one of the most severe penalties in the entire Canadian tax code, and it applies to TFSAs specifically. In 2026, with the growing popularity of alternative investments, private placements, cryptocurrency assets held through certain structures, shares of small private companies, the risk of accidentally holding a prohibited investment inside a TFSA has never been higher. If you have been expanding your TFSA holdings beyond traditional stocks, ETFs, and GICs, you need to verify with your financial institution or a tax professional that everything you currently hold qualifies under the rules. The fifth issue, and this one is going to surprise a lot of people, involves what happens to a TFSA when the account holder passes away. Many Canadians assume that if they name a beneficiary on their TFSA, the money transfers to that person tax-free, and that is the end of the story. But the reality is more nuanced than that, and getting it wrong can result in the surviving family members owing tax on income that has accrued in the account after the date of death. If your spouse is named as a successor holder, not just a beneficiary but a successor holder, specifically, then the TFSA transfers to them seamlessly and continues to grow tax-free with no complications. But if you have named anyone other than a spouse as a beneficiary, or if the beneficiary designation is not structured correctly, the income earned in the TFSA from the date of your death to the date the account is finally distributed can become taxable in the hands of the estate or the beneficiary. This is a planning issue that affects families every single year, and it is one of the most heartbreaking, because it hits people at the worst possible time while they are grieving, and presents them with a tax bill they were not expecting on money they thought was going to be received completely tax-free. So now that we have gone through the 5 key areas where TFSA holders are running into trouble in 2026, let me bring this back to something practical, and because knowing the risks is only valuable if you know what to do about them. Here is what every Canadian with a TFSA should do right now, today, without waiting another week. First, log into your MyCRA account online and check your TFSA contribution room. The CRA tracks this and it is available to you directly. Verify that your current TFSA balance plus any contributions you have made in 2026 do not exceed your available room. If there is any discrepancy between what you think your room is and what the CRA shows, contact them or a tax professional immediately. Second, look at your trading activity over the past 12 months. If you have been actively trading inside your TFSA, honestly assess whether the frequency and nature of your trades could be characterized as business activity. If you are unsure, get a professional opinion. Third, review any U.S.-listed securities you hold inside your TFSA and understand that dividends from those investments are subject to U.S. withholding tax. Consider whether those investments might be better positioned inside your RRSP, where the Canada-U.S. tax treaty provides an exemption from withholding on certain income. Fourth, review every investment currently held inside your TFSA and confirm it is a qualified investment under the Income Tax Act. If you hold anything unusual or alternative, verify its status. And fifth, if you have a TFSA and you have not updated your beneficiary designations recently, or if you have never reviewed whether your spouse is designated as a successor holder rather than just a beneficiary, make that change today. It is a simple administrative update that could save your family from a completely avoidable tax bill during an already difficult time. Here is the bigger picture I want to leave you with, and this is the thought that ties everything we have talked about today into one clear, honest conclusion. The TFSA is still one of the greatest financial gifts the Canadian government has ever given to ordinary Canadians. Used correctly, it is a genuinely powerful wealth-building tool that can shelter hundreds of thousands of dollars in investment growth from taxation over a lifetime. Nobody should walk away from today's video feeling afraid of their TFSA. What you should feel is informed. You should feel aware. And you should feel motivated to take 30 minutes this week to review your account, check your contribution room, and make sure everything is structured correctly. Because the difference between using your TFSA right and using it wrong is not a small difference. It is potentially tens of thousands of dollars in tax bills versus tens of thousands of dollars in tax-free wealth. The choice, once you have the knowledge, is an easy one. And that is the entire reason Pension Facts Canada exists. To give you that knowledge clearly, accurately, and without any agenda except making sure you are financially protected. We are here every single week with the updates, the explanations, and the practical guidance that helps Canadians make better financial decisions. If today's video helped you understand something you did not fully understand before, then please do 3 things for us right now. First, hit the like button. It takes 1 second, and it tells the algorithm that this information is valuable and should reach more Canadians who need it. Second, subscribe to Pension Facts Canada and turn on the notification bell so you never miss a video. Because we have critical content coming on RRSP rules, CRA audit triggers, CPP changes, OAS updates, and more that every Canadian needs to stay on top of. And third, leave a comment below right now. Tell me which of the 5 TFSA issues we talked about today was the most surprising to you. Was it the overcontribution trap, the day trading risk, the U.S. withholding tax, the prohibited investment penalties, or the beneficiary designation issue that affects families after a loss? Tell me in the comments. I read every single one and I respond as often as I can because your questions help shape the content we make for you. Thank you for being here today. This is Pension Facts Canada, and we will see you in the very next video. Protect your money, know your rules, and never stop learning.